I'll have more to say about our decision shortly, but first I will review recent economic developments in the outlook. Economic growth, which was subdued during the first half of the year, appears to have picked up. Household spending continues to be the key source of that growth. This spending has been supported by solid increases in household income, as well as by relatively high levels of consumer sentiment and wealth. Business investment, however, remains soft, both in the energy sector and more broadly. The energy industry has been hard hit by the drop in oil prices since mid-2014, and investment in that sector continued to contract through the first half of the year. However, drilling is now showing signs of stabilizing. Overall, we expect that the economy will expand at a moderate pace over the next few years. Turning to employment, job gains averaged about 180,000 per month over the past 4 months, about the same solid pace recorded since the beginning of the year. In the longer run, that's well above the pace that we estimate is needed to provide work for new entrants in the job market. But so far this year, most measures of labor market slack have shown little change. The unemployment rate in August, 4.9%, was the same as in January. And a broader measure of unemployment has also flattened out, a measure that includes people who want and are available to work, but have not searched recently, as well as people who are working part-time, but with fact that's well above the pace that we estimate is needed to provide work for new entrants in the job market. But so far this year, most measures of labor market slack have shown little change. The unemployment rate in August, 4.9%, was the same as in January. And a broader measure of unemployment has also flattened out, a measure that includes people who want and are available to work, but have not searched recently, as well as people who are working part-time, but would rather work full-time. The fact that unemployment measures have been holding steady while the number of jobs has grown solidly shows that more people, presumably in response to better employment opportunities and higher wages, have started actively seeking and finding jobs. This is a very welcome development, both for the individuals involved and the nation as a whole. We continue to expect that labor market conditions will strengthen somewhat further over time. Ongoing economic growth and an improving job market are key factors supporting our inflation outlook. Overall consumer price inflation, as measured by the price index for personal consumption expenditures, was less than 1% over the 12 months ending in July, still short of our 2% objective. Much of this shortfall continues to reflect earlier declines in energy and import prices. Core inflation, which excludes energy and food prices that tend to be more volatile than other prices, has been running about 1.5%. As transitory influences holding down inflation fade, and as the job market strengthens further, we continue to expect inflation to rise to 2% over the next 2 to 3 years. Our inflation outlook also rests importantly on our judgment that longer-run inflation expectations remain reasonably well anchored. However, we can't take the stability of longer-run inflation expectations for granted, and we will continue to carefully monitor actual and expected progress toward our inflation goal. Indeed, we are fully committed to achieving our 2% inflation objective. Let me turn to the economic projections now extending through 2019 that were submitted for this meeting by the Federal Open Market Committee participants. As always, participants conditioned their projections on their own view of appropriate monetary policy, which in turn depends on each participant's assessment of the multitude of factors that shape the outlook. The median projection for growth of inflation-adjusted gross domestic product, or GDP, is 1.8% this year. This figure is somewhat lower than projected in June as a result of the weaker-than-expected growth seen in the first half of the year. In 2017 and 2018, the median growth projection is unchanged at 2%, somewhat higher than the median estimate of longer-run normal growth. In 2019, growth edges down to 1.8%, in line with its estimated longer-run rate, which has been revised down a bit since June. The median projection for the unemployment rate stands at 4.8% at the end of this year, a touch higher than in June. Over the next 3 years, the median unemployment rate runs near 4.5%, modestly below the median estimate of its longer-run normal rate. Finally, the median inflation projection is 1.3% this year and rises to 1.9% next year and 2% in 2018 and 2019. Returning to monetary policy, the recent pickup in economic growth and continued progress in the labor market have strengthened the case for an increase in the federal funds rate. Moreover, the committee judges the risk to the outlook to be roughly balanced. So why didn't we raise the federal funds rate at today's meeting? Our decision does not reflect a lack of confidence in the economy. Conditions in the labor market are strengthening, and we expect that to continue. And while inflation remains low, we expect it to rise to our 2% objective over time. But with labor market slack being taken up at a somewhat slower pace than in previous years, scope for some further improvement in the labor market remaining, and inflation continuing to run below our 2% target, we chose to wait for further evidence of continued progress toward our objectives. This cautious approach to paring back monetary policy support is all the more appropriate given that short-term interest rates are still near zero, which means that we can more effectively respond to surprisingly strong inflation pressures in the future by raising rates than to a weakening labor market and falling inflation by cutting rates. We continue to expect that the evolution of the economy will warrant only gradual increases in the federal funds rate over time to achieve and maintain our objectives. That's based on our view that the neutral nominal federal funds rate, that is, the interest rate that is neither expansionary nor contractionary and keeps the economy operating on an even keel, is currently quite low by historical standards. Is only gradually to 1.1% at the end of next year, 1.9% at the end of 2018, and 2.6% by the end of 2019. Compared with the projections made in June, the median path for the federal funds rate has been revised down 0.25 to 0.5 percentage point. Most participants also marked down their estimate of the longer-run normal federal funds rate, with the median now at 2.9%. As I've noted on previous occasions, participants' projections for the federal funds rate, including the median path, are not a fixed plan for future policy. Policy is not on a preset course. These forecasts represent participants' individual assessments of appropriate policy given their projections of economic growth, employment, inflation, and other factors at a particular point in time. However, the economic outlook is inherently uncertain, and any assessment of the appropriate path to the federal funds rate will change in response to changes to the economic outlook and associated risks. Finally, we will continue to reinvest proceeds from maturing Treasury securities and principal payments from agency debt and mortgage-backed securities. As our statement says, we anticipate continuing this policy until normalization of the level of the federal funds rate is well underway. Maintaining our sizable holdings of longer-term securities should help maintain accommodative financial conditions and should reduce the risk that we might have to lower the federal funds rate to zero in the event of a future large adverse shock. Thank you. I'd be happy to take your questions.
Go to Steve first and then Howard.
Steve Leisman, CNBC. Madam Chair, critics of the Federal Reserve have said that you look for any excuse not to hike, that the goalposts constantly move. And it looks indeed like there are new goalposts now. When you say looking for further evidence, and you suggest that it's evidence that labor market slack is being taken up. Could you explain what "for the time being" means in terms of a time frame, and what that further evidence you would look for in order to hike interest rates, and also this notion that the goalposts seem to move and that you've indeed introduced a new goalpost with this statement? Thank you.
I'll try to respond to those questions. Let me try to set out again how the committee sees the economy and what we're looking for. We're generally pleased with how the U.S. economy is doing. Growth was weak in the first half of the year. We're seeing definite evidence that the economy is now expanding more strongly. As I mentioned, payroll gains in recent months have been solid, averaging around 180,000 per month, which is less than the pace in 2015. But as I mentioned, it's well above what's needed to provide jobs for new entrants into the labor force over time. The unemployment rate is pretty close to most FOMC participants' estimates of its longer-run equilibrium value. But, as I mentioned, that rate and other measures of labor utilization are little changed since the beginning of the year. I don't see that as bad news because it may reflect that the strong labor market is attracting people from outside the labor force back into employment. The labor force participation rates increased on balance since late last year. It is on a declining demographic trend, and the fact that it's increased shows substantial number of people are being attracted into the labor market. The employment to population ratio is also continued to increase. Now, we were not really certain that this is something that would happen as the labor market strengthened, and it's good to see that development has taken place, and that is some news that we've received in recent months, that the labor market does have that potential to have people come back in without the unemployment rate coming down. So we're not seeing strong pressures on utilization, suggesting overheating, and my assessment would be, based on this evidence, that the economy has a little more room to run than might have been previously thought. That's good news. Remember that inflation continues below 2%, although we expect it to move up over time. So the committee agrees that risks to the outlook have become roughly balanced. We expect labor market conditions to continue strengthening, and we are generally agreed that gradual increases in the federal funds rate to remove what is a modest degree of accommodation will be appropriate. But we don't see the economy as overheating now. My colleagues and I exchanged views at this meeting on the appropriate timing of the next step in reducing policy stimulus. Most of us judge that the case for an immediate increase in the federal funds rate is stronger, but that it would be sensible, given the finding of a bit more running room, to wait to see some continued progress, evidence that we continue to progress toward our objectives. So for the time being, we're going to watch incoming evidence, and you can see from the SEP that most participants do expect that one increase in the federal funds rate will be appropriate this year. And I would expect to see that if we continue on the current course of labor market improvement and there are no major new risks that develop, and we simply stay on the current course.
Howard?
Hi, Howard Schneider with Reuters. Chair, thanks for this. I was wondering if you could comment a little bit on the apparent tension between the steady drift down in the long run rate and the steady drift down in some of the projections and the seeming march toward a rate hike. If the neutral rate's coming down over time and continues coming down and you're eating up accommodation that way anyway, why not wait for the dust to settle on that before moving rates up?
So it is true that our estimates of the neutral rate are coming down, and that's what's largely responsible for that shift. At the same time, we generally agree that the stance of monetary policy is somewhat accommodative. So 180,000 jobs a month is a faster pace of employment growth and is sustainable in the longer run. Now, we have seen people come into the labor force and maybe more than would be expected, which is why the unemployment rate hasn't fallen, but that's probably not something that is possible without the economy overheating on an indefinite basis. So policy needs to be forward-looking. We don't want the economy to overheat and significantly overshoot our 2% inflation objective. That's one risk that we need to address. And I think we generally agree that some gradual increases to remove that accommodation will be appropriate if we stay on this course. But as I emphasize, it's not that much accommodation, and the economy has shown evidence that there are more people who are being attracted back into the labor force. So in that sense, I would characterize it as we've found the economy has a bit more running room. Nevertheless, we don't want the economy to overheat, and if things continue on the current course, I think that some gradual increases will be appropriate. And mainly what we discussed today were issues affecting the timing of such increases.
Go to Marty Kretzinger and then John Hilsenrath.
Marty Kretzinger with the Associated Press. Last month in your speech at Jackson Hole, you seemed to raise expectations that there could be a rate hike in September. Other Fed officials talked, including Vice Chairman Fisher. They seemed to support that. The Fed President Rosengren had some comments that sent the markets plunging. Then we had Governor Brainerd seem to draw back. Is this hurting the Fed's credibility, do you think? Or is this just the normal thing that we should be looking for at this time, uncertain time with the economy?
Well, I did say at Jackson Hole that I thought the case for a rate increase had strengthened, and that assessment is included in today's statement. So I think most of my colleagues agree with that assessment. I think we are trying to understand some difficult issues. There is less disagreement among participants in the committee than you might think listening to speeches and commentary. I think we all agree that the economy is making progress, that we are close to an unemployment rate that is one that's sustainable in the longer run. We all agree we are undershooting our inflation goal and that we want to make sure we stay on a course that raises that to 2%. And we're struggling with difficult set of issues about what is the new normal in this economy and in the global economy more generally, which explains why we keep revising down the rate path. And, it's very important that in a body like ours that a whole range of views are expressed, that we have independent-minded people who gather together and discuss these issues. My colleagues do explain in their individual speeches their own perspectives. These are complicated, complex issues, and it just isn't straightforward exactly how to interpret what is appropriate policy and exactly what is going on in the economy. My sense is that market participants and the public more generally learn more about the issues that we're grappling with as they listen to this set of speeches, and I think it's a very good thing that the FOMC is not a body that suffers from groupthink, and you see that's one of the real worries in an organization, that everybody thinks identically. But there's a lot that we share in common and express both in our statement and our speeches, and we're debating and discussing issues pertaining to timing.
Okay, John, and then we'll go to Craig.
John Hilsenrath from the Wall Street Journal. Chair Yellen, Donald Trump, the Republican presidential nominee, has charged that the Fed is keeping interest rates artificially low to support the Obama administration. I'd like to hear what you have to say to that charge. And on a related note, I wanted to ask you about the Fed's next policy meeting, which is in early November, a week before the next election. Given that the case for raising rates, you say today, has strengthened, should the public see that November meeting as a live meeting when a rate action could happen? Thank you.
Well, I think Congress very wisely established the Federal Reserve as an independent agency in order to insulate monetary policy from short-term political pressures. And I can say emphatically that partisan politics plays no role in our decisions about the appropriate stance of monetary policy. We are trying to decide what the best policy is to foster price stability and maximum employment, and to manage the variety of risks that we see as affecting the outlook. We do not discuss politics at our meetings, and we do not take politics into account in our decisions. As I said, we're generally pleased with the progress of the economy, and the decision not to raise rates today and to wait for some further evidence that we're continuing on this course is largely based on the judgment that we're not seeing evidence that the economy is overheating, and that we are seeing evidence that people are being drawn in larger numbers than at least I would have expected into the labor market, and that's healthy to continue, but that nevertheless, we do need to be forward-looking, and if we continue along this course, it likely will be appropriate to raise the federal funds rate. In November, you asked about as well. Well, every meeting is live, and we will again assess, as we always do, incoming evidence in November and decide whether or not a move is warranted.
Over to Craig.
Okay. Madam Chair, Craig Torres from Bloomberg. What observable data would convince you and the committee that this neutral federal funds rate is starting to move up? There's a popular piece of research by one of your colleagues that suggests it's at zero right now. And second, I'm struck by your opening remarks that the economy isn't overheating. But does that mean the committee sees this global reach for yield going on right now as very low cost to its policy? Thanks.
So you asked first what evidence would suggest that the neutral real rate is moving up. Well, I think if you saw us revising up our growth forecast, revising down our estimates, with an unchanged path for policy, if you saw this, you would see revisions in the funds rate path. But if unemployment were moving down faster than we had anticipated, if we saw faster growth or upward pressure on inflation, that would be suggestive of the appropriateness of reevaluating whether or not the neutral funds rate had had increased. I mean, the downward revisions reflect the fact that while the economy's made a lot of progress, it's only made that progress in the context of a monetary policy that has been characterized by extremely low interest rates and negative real yields for a very long period of time. Let's see. And then you asked about global factors. So global factors, capital flows.
About the global reach for yield and whether the committee saw that as a cost to its accommodative policy right now.
So in most advanced nations now, we have highly accommodative policies, and they seem to be necessary for countries to be able to achieve their inflation and employment objectives. And that's characteristic of an environment in which the neutral rate interest rates, both here and in advanced countries around the globe, appear to be very low. And that is an environment that if we do have to live with that for a long time, we have to be aware that it does give rise to a reach for yield as individuals and investors seek to perhaps take on risk or lengthen maturities to seek higher yields. And I think we should be concerned about that to the extent it creates financial stability risks. And we are very aware that those are possible. We engage in regular assessments of financial stability factors that bear on financial stability. Overall, I would say that the threats to financial stability I would characterize at this point as moderate. So I would characterize it as moderate. In general, I would not say that asset valuations are out of line with historical norms, but there are areas my colleague President Rosengren has focused on commercial real estate where price to rent ratios are very high or cap rates are very low, and that's something that has caught our attention. We have a variety of tools other than monetary policy to address such risks. We've recently issued new supervisory guidance pertaining to commercial real estate. I would say in the area of commercial real estate, while valuations are high, we are seeing some tightening of lending standards and less debt growth associated with that rise in commercial real estate prices. But more generally, we're not seeing signs of leverage building up or maturity transformation in the way that we saw in the run-up to the crisis, and we're keeping a close eye on it.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.